How is everyone doing tonight? Welcome to the Strategy Room. You are here with the banker next door, Dr. Joe Berquist, and I've got a great show for everybody tonight. We are going to be talking about what is going on with regional banks right now in America. I've got a ton of articles this week. We just had a lot of stuff blow up with regional banks here in the last couple of days. It all ties into all of the things, if you've been watching my weekly episodes that I've been covering. The bankruptcy of Tricolor Holdings, the bankruptcy of First Brands, the issues with the private credit market. We're going to talk about non-depository financial institutions, NDFIs. I also got updates for everybody on interest rates. We're going to take a look at the government shutdown. I've got some other things going on with regulatory news, other banking news I have going on. So we got a whole slate of things tonight. And we are going to kick it off here by going back to one of my, no, that's the wrong thing here. Hang on. Let's see here. Is that what okay, that's what, all right, this is what I want here. This is what I want. All right. Hey, guess what's working again this week? We got the debt clock. I got the debt clock back. I'm so happy. They finally fixed their website, which is great. So again, if we could just take a look at what we're dealing with here. So still cruising at 37,000.8, not 37,000, $37.8 trillion in national debt. Yeah, not going up anytime soon, but very happy to say that the U.S. federal budget deficit, the annual deficit, has now been knocked down to 1.7 trillion. Doesn't seem like, a huge big deal, but you've had probably about $250-300 billion knocked off of that in the last few months, which is great. It's like, at least a little bit of progress there. But looking in at the Doge clock, we're actually up to $674 billion in savings, upwards of $6,008 per taxpayer. And I can report that the debt to GDP has actually come down a little bit. It was actually hovering in at 123%. It's actually dropped now down to 120. Still a horrible number. still way, way higher than we would want it to be. But again, incremental progress, making a little bit of progress here. Now, I do want to point out one item here, and I know it might be a little hard for people to see on the screen there, but right in like the middle of the screen here, they have interest on debt. And they have a big exclamation sign on this particular thing right here. So this is the interest that we pay just to service the national debt. Like, think of it like the interest that you're paying on your credit card every month. So this is the interest on the national debt, and we are basically $969 billion, almost at $1 trillion in annual debt service, and that's just to service this $37.8 trillion of the national debt. So we're almost at the point where we're spending $1 trillion a year just to pay and service the interest on our national debt, which is almost $38 trillion now. I mean, it's absolutely stunning when you look at a lot of these numbers. But that's why we like to look at it, and that's why I like to share with everybody. So okay, so that's the update on the debt clock there. Let's take a look at interest rates for a second here, shall we? Now, I want to take a look here at the 10-year Treasury note, as that is the most important note because it drives everything in our lives. It drives your credit card rate, drives mortgage rates, drives your auto loan rate, drives student loan debt, drives everything, all tied into the 10-year Treasury note. Now, I had said, if you remember, that I thought that yield was going to come back down to 4%, and that at 4%, it was probably going to hit some type of a resistance. And the real question was not whether it was going to come back down to 4%, but whether it was going to break through and drop, into the 3.9, 3.8, and what that ultimately looks like. Now, surprise, surprise, what happened here today? Oh, look at that. It dropped down to 3.9%. It actually broke through the 4% barrier for a little bit, and then it's perked back up throughout the day, and basically ended the day at 4.013. So still slightly up a little bit, but it ultimately came back down where I thought it was going to go, and that was at right around 4%. A little bit. Should be a little bit lower there, but still, again, that's good. That's what we want. We want this to move back down. So again, and like I said, this was going to be a little bit of a slow and incremental process. And then hopefully this will begin to correlate to the 30-year mortgage and the 15-year mortgage. Hopefully, if the Federal Reserve continues to cut rates, get that federal funds rate down a little bit more, and if we could get the Treasury market to play nice, hopefully we'll see what happens with some of this stuff we're going to talk about here with some of the trade things and other things going on. Trade war with China not looking so hot right now at the moment. So, but we'll, like I said, we'll get back to that. But I just wanted to show you, like, again, we are making some progress here with the interest rates. It's slow and steady, but we're getting there. So, okay, something I want to share. I always like to share this infographic with everybody. This is from my favorite acronym in the banking business, NACHA, the NACHA. So this is basically the ACH network, payment flow network. So how are they doing so far here? They put this little infographic out quarterly. I just like to share because I think there's some really interesting information on here. So for the third quarter of 2025, we had volumes total of 8.8 billion. B2B volume rises 10% from a year earlier. Sorry, guys, early break tonight. Here, a little Diet Coke plug there for you. So I know their sponsorship money will be rolling in any minute. Third quarter 2025 total ACH network volume of 8.8 billion, 4.9 billion in debit cards, and 3.9 billion in credits. Overall value of B2B increased 8.8%. The value of the B2B climbed through same-day ACH limits by 15%. So we could see here, and actually, I'm going to make this a little bit smaller, actually. It makes it a little bit easier to see. So we can see here that B2B via the same-day ACH increased from 509 billion in the third quarter of 24 to 585 billion in the third quarter of 25. Business to business, B2B overall, 14.7 trillion in the third quarter of 24, now up to 16 trillion here in the third quarter of 25. Same day ACH value increases 15% from 844 billion in the third quarter of 24 to 970.4 billion in the third quarter of this year. Volume across major transaction types compared to the third quarter of 2024, so compared to a year ago. Healthcare up 6.8% to 141 million. The internet up 6% to 2.9 billion. Direct deposit up 2.5% to 2.2 billion. And P2P, in other words, peer-to-peer payment. Think of Venmo, Zelle, Cash App, that kind of thing. So P2P payments up 22.7% to 122.2 million. So again, phenomenal results. And I like to show this just so you can see what's going on there in terms of digital payments. Digital payments out there are just constantly increasing, which again, for the most part, is a very good thing because it just shows you that digital payment channels are really increasing and really doing very well. So that in and of itself is a very good thing. So let's go. Let's take a look at some things here. Now, we're going to get into what's going on with the regional banks. But before we do that, I want to set the stage here by talking about the repo market, because I think there were some really interesting developments in the repo market that I wanted to share everybody. Now, anybody who's watched the show before knows this is a very familiar chart. This is from the FRED database. So the St. Louis Federal Reserve Bank, they have the FRED database, which is one of the best sources out there for a lot of data. So this is what's called for the repo market. This is the overnight reverse purchase agreements. Now, this is Treasury securities sold. Now, what is very interesting about this chart, this runs from basically 2021 up until today. And I want you to see that, this is we peaked out here at about 2.5 trillion in liquidity here in the repo market. And that was January of 2023 is when we peaked out here. And ever since, we've just been coming straight down. Now, where are we at here? We're at about $3.5 billion. It is, literally all of the liquidity has been sucked out of the repo market here. And you might say, well, why is this important? Well, this is important because after the financial crisis in 07, 08, 09, and when the Federal Reserve really got into what was called ZIRP, their zero interest rate policy, and they got into quantitative easing, and they went to the moon with quantitative easing for about 10 years. When they did that, they made a very fundamental change to our economy, and they put the repo market right into the center of the economy, because basically this was the juice, if you will. This was the engine oil, that juice that kept the economy going, all the liquidity here in the repo market. And so the repo market, it becomes very, very critical just to the everyday operations of the overall financial system, of the overall market itself. And so not having drained all the liquidity out of the repo market is not a good thing. Like, this is not a good thing, and not because it's just the market dynamic. I guess that's the point I'm trying to drive home here, is that the market dynamic of the repo market and how it works. It wouldn't be, again, going back before '08, repo market was kind of this very quiet little market, not really too much going on, not really the center of attention, so to speak. But like I said, after '08, the Fed put these guys at the center of everything. And that's why this becomes such a big deal. Now I'm going to show you another chart here. So here we go. Now this is a very interesting chart. Now you're looking at this again. This is overnight repurchase agreements, Treasury securities purchased by the Federal Reserve. Now, you might notice that there are some spikes on this chart. You might say, those are some, I see like kind of a flat line here at the bottom. And then all of a sudden I see these massive spikes. Okay. These are massive spikes in liquidity in the repo market. So in July, we had this massive spike up of $11 billion, just like that. Boom. And then over here. Now, you might notice at the end of the chart here, this goes over to today. And on September 15th, what do you have? 1.5 billion. And then we had another spike here, September 30th, another 5 billion. And then just the other day, October 15th, 2 days ago, we had another spike here, 4.7 billion going in. So again, this is what's bothering me, is that you go back, is that you're seeing this draining out of liquidity here in the market. And then you're starting to see these spikes, meaning that what this is telling you is that the market, i.e. banks, hedge funds, they need cash. So they're basically, you're seeing these spikes. You're seeing these little mini spikes here in the repo market. And this is very telling of what's going on here. And again, these are not great signs. That's what I'm trying to point out to people, is that these are not the type of things that you want to see. So, okay, now before we get into all these other articles here, I needed to read everybody this definition. So I just got this off of Google real quick, because this is going to play into this whole conversation we're going to have around what's going on with the regional banks here. So, a non-depository financial institution, an NDFI. You say, well, what is that? Okay, that is a financial entity that provides financial services but does not accept deposits from the general public. Unlike traditional banks, instead, an NDFI funds their activities by other means, such as selling securities or insurance, and includes a wide range of institutions like investment banks, insurance companies, mutual funds, and mortgage lenders. What are some of their key characteristics? There are no public deposits. They have diverse funding sources. They raise capital through various methods, including selling stocks, bonds, insurance policies, and through other forms of credit intermediation. They have a wide range of services. NDFIs provide a variety of financial services, such as investment management, asset management, lending, and market making. I want you to key in on that. Now, what are some examples of NDFIs? Well, you could have investment banks, insurance companies, mutual funds and hedge funds, mortgage companies, pension funds, broker dealers, and finance companies. Okay, what do the finance companies do? Well, they provide loans, such as consumer or captive finance companies, to finance a manufacturer's products. So hopefully that paints out what is a non-depository financial institution. Now, what is key to remember is these NDFIs, they are not regulated like banks are. They do not have anywhere near the amount of regulation that banks do. So now that we understand, we're all on the same page here. We all understand what an NDFI is. Okay, now let's get into some of these articles here. So, new credit fraud fears raise more worries about regional banks. So bank shares were hammered Thursday after ties emerged between several banks and borrowers accused of fraud. So regional banks faced renewed scrutiny over Zions Bancorp disclosed a large loss and fraud accusations against borrowers tied to other lenders. So regional banks came under renewed scrutiny Thursday after Zions Bancorp said it would take a large loss and revealed accusations of fraud against a set of borrowers who had ties to another of other lenders in the industry. Now, that would be namely Tricolor Holdings and First Brands. I don't know why, they don't name them here right away in the article. I don't know what the big secret is, but the disclosures helped send bank stocks reeling to their worst day since President Trump's tariffs hammered the market in April. Evidence of how on edge Wall Street is after the recent high-profile bankruptcies of auto suppliers First Brands and auto lender Tricolor. It wasn't clear how widespread any pain would be from the new allegations, which center on a set of investment funds that are now being sued by several banks. So Salt Lake City-based Zion said it was filing a lawsuit to recover more than $60 million it had lent to investment funds Cantor 2 and Cantor 4. The funds had used the revolving credit facilities to purchase distressed commercial mortgage loans, Zion said. Phoenix-based Western Alliance Bancorp is seeking to recover roughly $100 million from Cantor Group 5, an entity managed by the same leadership team, according to Zion's lawsuit. Brandon Tran, a lawyer for the individuals behind the group of Cantor funds, Andrew Stupin and Gerald Marcel, said in a statement that his clients vehemently deny all the allegations of wrongdoing. These claims are unfounded and misrepresent the facts. Transcend. We are confident that once all the evidence is presented, our clients will be fully vindicated. Now, I want you to keep in mind, this whole thing is a mess. Okay, these banks are never going to recover any of this money. Okay, this money is gone because this was all. I mean, the whole thing with First Brands is a wild situation. And I would tell everybody, go watch. I just did a whole bunch of episodes. I covered the Tricolor Holdings bankruptcy. I covered the First Brands bankruptcy. I've covered how this all ties in with the private credit market. I've covered various episodes with warnings on the private credit market, from the Federal Reserve Bank of Boston to Moody's to Fitch. All those episodes are out there. You could go look them all up to get all the good, juicy details on this. But I just wanted people to understand how tied in all these different banks, all these banks are involved in this. That's the big takeaway I want you to take away from this. All the banks are involved in this hot mess, and this is only going to get worse. These are just the first two failures. I can promise you that there is, just as the sun will come up tomorrow, there is going to be more. Because I've been talking about this for the whole year now. I've been talking about this, the private credit market, and how it is this giant steaming pile of crap. And this was all going to burst out at some point, and that's why everybody on Wall Street was in panic, because they know that all of these regional banks and all of the big banks are all tied up in this private credit market that leads back into the NDFIs, non-depository financial institutions. Now, so let's go on here for a second here. So Zion's and Western Alliance shares fell 13 and 11% respectively. Those banks were among the hardest hit by a crisis of confidence in the industry after Silicon Valley Bank and First Republic collapsed in 2023. In a statement, Western Alliance said it has sufficient confidence in its credit portfolio to affirm its guidance. Sure they do. On Thursday, investors dumped shares of banks broadly, particularly smaller ones whose business models have been increasingly challenged by the dominance of the mega banks. An index of regional banks dropped 6.3%, while the broader KBW NASDAQ Bank Index fell 3.6%, both their worst days since April. Investors have been anxious and about more potential credit blowups after the collapse of First Brands and Tricolor raised broader questions about underwriting standards. Shares of Jefferies Financial Group fell more than 10% Thursday after the Wall Street Journal reported on the firm's deep ties to First Brands, and the company provided an update to an investor meeting. The Zion loans didn't appear to be related to those bankruptcies, according to Evercore President John Pancari, and instead represent a different borrower issue. Bankers have maintained there is no wider reason for concern, though JP Morgan Chase Chief Executive JB Diamond has warned he is watching. Oh, well, that's good. I'm glad he's watching. When you see one cockroach, there are probably more. There you go. All right, let's go. Let's go Dawn here. So this was CNBC this afternoon. The tide went out. How a string of bad loans has bank investors hunting for hidden risks. So Thursday's sell-off among regional banks drew comparisons to the 2023 banking crisis that consumed Silicon Valley Bank and First Republic. Now, first of all, I really don't see any comparisons between the two. They're two completely different situations. Silicon Valley Bank and First Republic Bank, those were really more similar to a classic run on the bank type situation where the deposits just got sucked out and they, just total loss of liquidity. That's not this. This is bad loans. Like this is bad loans. This isn't. We haven't seen any run on any banks yet. Nobody's failed as of yet. So again, it's kind of hard to compare this to the banking crisis of 2023. Now, one area you can absolutely compare this. If we go back to our trusty chart here, we can absolutely compare this. Like if we go back here. I want to see, again, we just compare, we look at the repo market and we just look at liquidity spikes in the repo market. You go back to, again, we could go back to beginning of 2023, we had $2.1 trillion in the repo market back then, which was, okay, we had plenty of liquidity in the repo market. Today, we got nothing. We got nothing in there today. So that's what is concerning to me now. But Thursday sell-off among regional banks, again, that drew comparisons, but Zions and Western Alliance are facing scrutiny after heavy losses from alleged loan frauds tied to non-depository financial institutions, or NDFIs. NDFIs are a fast-growing category of loans made by non-bank financial firms, but often funded by regional banks and global investment banks alike. Yes, now this is where you begin to see, this is where the NDFIs come in. Now, keep in mind, this is all part of what's called the private credit market. The NDFIs are all part of the private credit market. That's the tie-in here. Now, here's another bank. Regional bank stocks plunge on rising NDFI credit concerns. So U.S. bank stocks underperformed the broader markets, with regional bank stocks especially impacted as an uptick in one-off credit events drew increased investor scrutiny of loans to non-depository financial institutions. So the S&P 500 fell 1.6% from the market's close on October 9th to the close on October 17th. Again, the KB index was down a little bit. In recent weeks, several banks have disclosed credit exposure to non-depository financial institutions that filed for bankruptcy or were accused of outright fraud, including Tricolor Holdings, Tilson Technology Management, Inc. There's another one for you. Subsidiary Boundless Broadband, and First Brands Group, LLC. So I'm going to have to look up this Tilson Technology Management because that's a new one. I had not heard about that one yet. As the banking industry began reporting its third quarter earnings, companies such as Western Alliance Bancorp and Zions Bancorp provided new details about their exposure to troubled credit relationships and company filings. The string of bad news around NDFI lending has set off regional bank jitters among investors, according to Morningstar DBRS analysts. Losses have been low. So these recent and numerous larger loan issues have raised fears of a broader deterioration, the analyst wrote. Moreover, in each of these issues, there have been fraud allegations causing investors to worry about the pervasiveness of fraud in bank loan portfolios. In another note published on October 16th, JP Morgan analyst Anthony Elliott wrote that he is questioning why so many credit one-offs are cropping up in such a short time frame, adding that even if these exposures are well contained and have a limited financial impact, that is unlikely to quell investor concerns. This is an industry where investors, especially those that are new to this sector, tend to sell first and ask questions later, especially when it comes to elevated credit concerns, Elliott wrote. The analyst believes investors are taking this approach because there has not been a downturn or recession in more than a decade that would have tested the regional banks' loan portfolios. Elliott added that the government's COVID-19 stimulus alleviated the pandemic stress, and the industry's challenges around spring 2023 were related to liquidity concerns, not credit concerns. Exactly what I was just saying. And then we can see here some of the best and worst performing U.S. bank stocks. Triumph Financial Group doing well, Wells Fargo doing all right, Bank of America. Those guys just released earnings this week. First Capital doing bad, down 11%. Rhinebeck Bancorp, Western Alliance that we talked about, 11.6%. Bank of California down 11.6%. Eagle Bancorp 11.6%. Hancock Whitney Corp down 11.7%. Hingham Institutions for Savings down 13.3%. First Horizon down 14.9%. First Guarantee Bank Shares down 15.5%. And of course, the big one, Zions Bank, down almost 16% there. So, I mean, again, just getting clobbered this week. Now, what's interesting is that I did one of the episodes that I did on the private credit market where I talked about, Finch Ratings, one of the big rating companies coming in, basically warning about the private credit market. And then also in that episode, I noted how Moody's had also issued a warning on the private credit market. Now, what does Moody's have to say now? Well, Moody's says the banking system, private credit markets are sound despite worries over bad loans. Despite worries over bad loans at mid-sized U.S. banks, there's little evidence of a systemic problem, according to Mark Pinto, Moody's head of global private credit. One cockroach does not a trend make, Pinto said, obviously quoting Jamie Dimon there. Market sentiment appeared to improve Friday after a sell-off on Thursday. So despite worries over bad loans at mid-sized U.S. banks, there's little evidence of a systemic problem, according to a senior analyst at Moody's Ratings. Mark Pinto, the agency's head of global private credit, acknowledged in an interview on CNBC Squawk Box that there are concerns over loose lending standards and some slack in the conditions that institutions attach to loans. However, he said when looking at the system as a whole, contagion, the likes that could trigger a broader financial crisis, is not evident. When we dig deeper here and look to see if there's a turn in the credit cycle, which is effectively what the market seems to be focused on, we can find no evidence. Wow, that's amazing. No evidence. That's interesting because I thought we had Tricolor Holdings, Tulsa Technology Management, and First Brands Group all biting the dust, but there's no evidence. No evidence, folks. Do not believe your lying eyes. Bank stocks sold off aggressively across the board Thursday after Zions and Bancorp. We know that. The worries have dragged out shares of investment bank Jefferies this month. We're going to get into some other things in there, but I would just remind people that this is what they do. Okay. When the house is, it's like that classic scene from the original Naked Gun movie with Leslie Nielsen, where the fireworks building is blowing up behind him. The whole building's exploding. People are literally jumping out the windows, running. One guy's on fire, and he's standing in front of the building, telling the crowd, "Nothing to see here. Nothing to see here. It's fine. Disperse. Everything's fine. Go home. Nothing to see here." That's exactly what the beginnings of what you're seeing here. There's the building. You can't quite see the building on fire, but there's smoke coming out the roof, and you're like, okay, something's not right there. But again, this is what they do. I mean, I go back to 07, 08, when you could see the mortgage market melting down, and these guys were all there till the bitter end, like, oh no, it's fine, don't worry about it, it's good, nothing to worry about, nothing to see here, everything's fine. All right, now let's get into some of the individual cases here that have been announced. So I got like 3 or 4 articles here, and you guys are going to begin to see all the companies, all the different banks and everything involved in this. So first up, JP Morgan Chase quantifies Tricolor exposure and proves card loss forecast. So JP Morgan Chase and Company reported slightly elevated wholesale loan charge-offs due to the bankruptcy of Tricolor Holdings, while lowering its projection for credit card net charge-offs, reflecting favorable delinquency trends. In wholesale, I want to get to the point. Okay, JP Morgan Chase's total net charge-offs increased $183 million sequentially, and $506 million from the year prior to $2.593 billion, including $170 million from exposure to Tricolor. In wholesale, charge-offs were slightly elevated as a result of a couple of instances of apparent fraud in certain secured lending facilities, CFO Jeremy Barnum said during a conference call with analysts. Otherwise, in both wholesale and consumer consumer credit performance remains in line with our expectations. So a number of banks have exposure to Tricolor. JP Morgan Chase, it had no exposure to another high-profile recent bankruptcy, that of First Brands Group LLC. The Tricolor loss is not our finest moment, Chairman and CEO Jamie Dimon said on a call with reporters. Yeah, I guess that happens when you lose $170 million. And when something like that happens, you could assume that we scour every issue, every universe, everything that has to be taking place to make sure it doesn't take place from here. You can never completely avoid these things, but the discipline is to look at it in cold light and go through every single thing which you can imagine you've already done. Actually, no, you can avoid these things, Jamie. You can. I love, Jamie's the best, dude, right? He's like the biggest, baddest banker in the country, right? Everybody knows who Jamie Dimon is. But Jamie Dimon has done a lot of double talk in the last couple months. And so he literally got up on CNBC and he warned about the private credit market. He literally got up there and was like, yeah, I got some concerns about the private credit market. I'm really worried there could be a problem there. And then literally in the same interview, the people were like, well, Jamie, like, if you're so concerned, what's JP Morgan doing? Are you guys invested in the private credit market? Oh, of course we are. Yeah, we've got like $60 billion, $100 billion in the private credit market. It's like, wow. But you're highly concerned about it. And then, and then this stuff happens and he sits there and he goes, well, this stuff just kind of happens, and we, you can't completely avoid these things. And it's all about the discipline, it's like, no, the discipline, Jamie, would be not to get involved in the private credit market in the first place because you knew it was a problem. Okay. So yes, in fact, these things can be avoided. It's called greed. It's called, yes, don't be greedy. Yes, so these things absolutely can be avoided. So, okay, so there's JP Morgan, the first victim here, losing $170 million to Tricolor Holdings. Now let's take a look at here. Now we got Zion's and Western Alliance shares slide on fraudulent loan news. So shares of Zion Bancorp and Western Alliance Bancorp are under pressure after the companies disclosed alleged exposure to allegedly fraudulent lending relationships. So Salt Lake City-based Zions is taking a $50 million charge off and a $60 million provision related to 2 commercial and industrial loans after an internal review found apparent misrepresentations and contractual defaults by the borrowers and obligors, as well as other irregularities with respect to the loans and collateral. This follows Zion's discovery of legal actions initiated by other lenders against parties linked to 2 borrowers under the loans. So in other words, all the lenders came out with the lawyers came out a blasting from all sides because everybody knows they're going to take a bath on this and they don't want to get, nobody wants to be no one wants to be there when the music stops and they don't want to get left without a chair. Zion's disclosure prompted investor inquiries at Western Alliance, which then released an 8K confirming their exposure to the same clients through a revolving credit facility. So October 16th, Zion's stock price was down 9.10% from the prior day's closing price, while Western Alliance's stock had fallen 8.44%. Unfortunately, it would get worse for Zion's, as I recently said just a few minutes ago, as they were down almost 16% on the week. So, and then looking at the lawsuits, Stephens analyst Terry McAvoy identified the customers as Andrew Stupin, Gerald Marcel, and others, as well as investment funds Cantor Group 2 LLC and Cantor Group 4 LLC. Western Alliance has filed a complaint seeking $100 million in recoveries, according to McAvoy's note to clients. So, okay, then let's go to the next one here. So now we got U.S. Bancorp. Discloses First Brands exposure, non-bank lending details. So U.S. Bancorp is confident in its loan book despite a recent one-off bankruptcy blip and growing non-bank lending exposure. The Minneapolis, Minnesota-based company's non-performing commercial and industrial loans totaled $708 million in the third quarter, up 30% from $548 million in the second quarter, partly due to exposure to First Brands Group, which filed for bankruptcy in September. The company has already fully baked that exposure into its reserve and is confident in its underwriting, despite the hiccup, executives said during a conference call on October 16th. I don't think we'll do anything differently. We have very, very strong underwriting capabilities. When you have a large book, you have 1 or 2 issues. President and CEO Gunjan Kida, if I'm saying that right. So I'm not sure there's anything to be done differently, but to remain very vigilant and rely on your strong traditional underwriting strength. Everybody, just to be sure, everybody has strong traditional underwriting strength. It's just those banks that fail that don't have the strong underwriting. Even though they tell you as they're failing that they have the strong underwriting. So just so you understand how that works. If you're confused, don't worry, you're not the only one. In other words, there might be a little embellishment. Every bank. It's like I always say about banks. If you put 10 bankers in a room and you say, okay, who's got great customer service? I guarantee you all 10 banks are going to raise their hand and say, we got great customer service, even though you could look at the 10 banks and you could go, okay, half of you guys, your service absolutely stinks. I know it stinks. You know it stinks, but they'll never admit to it. Like they'll never admit that the service stinks. Everybody's got excellent, par none, fantastic service, no questions asked, and it's the same thing with, credit underwriting and lending standards. I could get 10 banks in a room and I could look at them and say, okay, who's got, strong traditional underwriting strength, and every single bank is going to raise their hand. We've all got it, even though, they're going to look at that row and you're going to go, okay, yeah, you're going to go, okay, 3 of you guys are excellent, 3 of you guys stink, and the other 4 of you guys are in the middle. Like that's always how it's going to break out. So, all right, the company, now here's the key thing here. Now, this is U.S. Bancorp, which is, 5th largest bank in the country, a huge bank. So the company has $45 billion in outstanding loans to NDFIs at September 30th, making up 12% of their total loans. The bulk of its NDFI loans, 27.3%, were to business credit intermediaries, while the second largest component was private equity at 26.9%. Consumer credit loans made up 17.3%, while mortgage intermediary loans made up 16%, and 12.5% were other. So that is a huge exposure, even though they're a massive bank, they got hundreds of billions of dollars in assets. $45 billion in outstanding loans to NDFIs. That is an enormous exposure. Okay. And again, what I want people to understand is that it does not take a massive amount of delinquency in order to sink a bank. Like, in other words, I want people to think about it like this, like during the financial crisis in 07, 08, 09, we had, I think it was over 800 bank failures. Now, a lot of those banks failed because, again, they had lower capital requirements back then. So say the capital requirement was 4% or 5%. Say it was 4% back then. So if you have delinquency of 5% and you have capital of 4%, guess what? You're out of business. Like, that's it. You're done. So it took 5% delinquency to sink the bank. Okay. That's what I want people to understand is it. And then when you are analyzing banks and you're looking at delinquent numbers, a good bank, a normal bank probably has about a 0.5% or less in delinquency is usually pretty good. That's usually pretty standard. You could go up to 1%, even if a bank is cruising around 1% delinquency. Okay. Not the, 0.5% to 1%, not the end of the world. That's okay. Not the biggest deal. But once a bank starts to go over 1% delinquency, especially if they start to creep up to like 1.5%, and especially if they get to 2%, that's when you're really starting to look going, what's going on here? What's happening there? Now, what's better today is that banks have much higher capital requirements today. So a lot of banks are maintaining, capital requirements at, 8%, 10%, 12%. Even 14%, which is great. But it's but again, I'm just trying to make the point that it doesn't take this. A lot of people think that, the bank might have to have 20%, 30% delinquency in order to sink the bank. But that's not the case. If a bank goes down, again, if a bank gets 5%, 8% in delinquency, that could be game over. That could be, lights out. So, okay. All right, let's keep going on here. I just got a couple more with this. So, Comerica acquisition will lower Fifth Third's NDFI lending balance. So, if everybody remember, I just did an episode. There's this biggest bank merger we've had in the last 5 years. Fifth Third Bancorp announced that they were going to buy Comerica for $10.9 billion. And now they're basically coming out saying Fifth Third Bancorp's acquisition of Comerica will slightly lower the combined company's balance of loans to non-depository financial institutions lending balance, executives say. So the disclosure follows the high-profile bankruptcies of two non-depository financial institutions and investor scrutiny of Fifth Third and other banks with loans to those companies. So Fifth Third reported elevated net charge-offs from 45 basis points in the second quarter to 109 basis points in the third quarter because of exposure to Tricolor Holdings, including $178 million in net charge-offs tied to the subprime auto lender. So you've got JP Morgan losing $170 million, and now you got Fifth Third Bancorp losing $178 million. To the subprime auto lender. The company is confident in their quality of remaining clients in the NDFI portfolio after a comprehensive review. Yeah, okay. In light of the recent acquisition announcement, Schroek said, who is, I think is what, their CFO? No, he's a chief credit officer. Said the team conducted a review of Comerica's NDFI portfolio. The company's combined NDFI portfolio balance is expected to fall 7% from Fifth Third's current balance of 8%. But that's not really the number we're looking for. The number we're looking for is just like what we just saw with US Bank. Like, what is the overall exposure? What is the overall exposure here to these guys? That's what we're looking for. We're looking at. Comerica's NDFI portfolio is concentrated in low-risk subscription facilities, which complements our disciplined approach to client selection and portfolio diversification. We feel really good about the ongoing diversification and overall asset quality of the remaining portfolio. So, we'll take that at face value for the moment, right? We'll take that at face value, and we'll see, where that goes. Now, all right, now let's talk about Jefferies for a second. So Jefferies execs go on damage control over First Brands. So the bank CEO and president distanced their company from the bankrupt auto parts supplier and emphasized Jefferies' liquidity, assets, and a burgeoning partnership ahead of its investor day on Thursday. So 3 weeks ago, executives at Jefferies might have been excused for thinking the lead storyline at the bank's investor day this coming Thursday would have been details of an enhanced partnership with Sumitomo Mitsui Banking Corp. That changed last week when Jefferies disclosed exposure to debt from the bankruptcy of two auto parts suppliers, First Brands. Or to just the bankruptcy of auto parts supplier First Brand. So Jefferies CEO Rich Handler and President Brian Friedman in a letter Sunday sought to stem the tide of concern from investors who have sent the bank stock plunging 22.6% since September 30th, just after First Brands declared bankruptcy. The executive said Jefferies' exposure to First Brands is about $45 million, a far smaller figure than the $715 million mentioned in last week's disclosure. Relative to the scale of Jefferies, we are confident that any losses or expenses from these investments can readily be absorbed and do not threaten our financial condition or business momentum. First Brands, meanwhile, announced Monday that its CEO and founder, Patrick James, resigned. Charles Moore, the company's chief restructuring officer, is now serving as interim chief executive. Our immediate priority is to ensure stability and dependability for our employees, customers, and partners, Moore said in a statement Monday. Many leaders are investigating First Brand's off-balance sheet financing, Moore indicated. Yeah, they're not the only ones, allegedly. The Justice Department, too, is reportedly probing the situation. Moreover, Moore, meanwhile, is working to sell the company's portfolio of brands. First Brands received $1.1 billion in bankruptcy financing to keep the business going, but that's less than half of the $2.3 billion advisors say First Brand owed to purchasers of the receivables as of the company's bankruptcy. So, yeah, and again, in the episode that I did on First Brands, go check that out. I explain all that stuff and what was going on there. Now, here's the thing. Here's a couple articles just talking about analysts and their perceived projected rent growth or projected revenue growth for most big banks, despite the new credit cracks. But I want to come back to that in just a second. I just want to review real quick. So again, just to point out all of the banks so far that we have seen involved in this: JP Morgan losing 170 million, Zion's Bank and Western Alliance both losing, Zion's Bank taking a $50 million charge off and a $60 million provision here. Western Alliance Bank is basically trying to recover $100 million. Not insignificant losses. Then you get to U.S. Bank Corp, and you see that they have a problem here. They're having a problem here with a bunch of these loans, and they still have a huge portfolio of NDFIs. Then we come down here to Fifth Third Bank Corp, who's in the process of acquiring Comerica. So again, there are a ton, and then we get to Jefferies, Financial. So there are a ton of banks and other financial firms like Jefferies, investment firms involved in all of this, and this is a ripple effect that is going to go through here. Now, of course, the first thing they're all going to do is say, "Hey, we checked the books, we checked the numbers, everything's good, everything's fine, don't worry about it, everything's hunky dory." Of course, they're gonna go into that and they're gonna say that. Again, I don't believe that to be the case. I think these are just the first dominoes to fall, because it all leads into, the NDFIs effectively play in not the total market, but they're a big chunk of the overall private credit market. And the private credit market, that's the big issue, right? That's the big issue that we're looking at. But let's look at what do the analysts here say about the revenues here? So this is a revenue about most of the big banks. So analysts anticipate another period of solid financial performance by U.S. big banks for the third quarter, which they all did. They all basically had great earnings this week, with expectations for revenue growth and healthy credit holdings despite some recent cracks. Across the 14 publicly traded banks with more than $100 billion in assets, which start reporting results October 14th, the consensus anticipates year-over-year growth in earnings per share for 13 banks and sequential earnings per share growth for 7 of them, according to data from Visible Alpha. Revenue is expected to increase sequentially at 12 of them, and analysts do not generally forecast substantial increases in credit costs. So, and again, JP Morgan, Citibank, Wells Fargo, Bank of America, PNC, again, pretty much, I think they all, had really good earnings this week. I mean, everybody put out, I know I saw also Goldman Sachs, Morgan Stanley, also, putting out very good numbers. So again, good numbers on the far. The question is the credit. What is the credit ultimately going to go there? And then here's another one. Analysts expect improved earnings for most regional banks in the third quarter of 2025. Analysts expect most regional banks to report sequential earnings gains in the third quarter and for the Federal Reserve rate cuts to bolster the industry's performance in the future. Hopefully we will see rate cuts from the Fed. We don't know. We don't know for sure. So of the 51 banks with assets between 10 billion and 100 billion, as of June 30th, analysts project 26 to report higher earnings per share quarter over quarter, while 22 are expected to post lower earnings per share sequentially. According to S&P Global Market Intelligence analysis of consensus estimates, 3 are projected to report no change. Banks with between 10 billion and 100 billion in total assets started reporting third quarter earnings after the October 14th market close. Results in the segment should reflect improved financial metrics such as expanding net interest margins, recovering loan growth, and stable credit quality. So, all right. So again, but we're going to get to the government shutdown here in just a second. So just to take a look at this, I just want people to understand that, this is something I've been warning about here all year. All year, I've been harping on the private credit market and how I thought this was a big problem. And this was eventually going to blow up, in a lot of these banks' faces. And I believe we're at the beginning of that now. We're at the beginning of all this now. So again, just, buckle up and hold on, because I can guarantee you there's going to be more. So, all right, now let's get into the government shutdown for a minute here. I just have a few articles here related to this. Just wanted to share, kind of give everybody an update on what was going on. So, government shutdown. So, Senate bill fails for the 10th time. Now, this was yesterday on Thursday. Kelly tells Trump to get involved. So Democratic Senator Mark Kelly called on President Donald Trump to push his fellow Republicans to negotiate with Democrats to end the government shutdown. Republicans and Democrats have not budged on stopgap funding bills as the government remains largely closed for more than 2 weeks. Again, I think we need the president needs to engage with Mike Johnson and John Thune, Kelly said. Kelly noted that Trump has said he wants the question of ACA subsidies addressed. So we're sitting on here. So we're I think 15 days, 16 days into this thing. No, actually longer than that. So this is 7. So we'd be about 18 days because I think it was September 30th. So actually it was 17 days. So 17 days into the government shutdown. So now here's from 2 days ago. Government shutdown enters 15th day, regions most and least impacted. So data shows that Washington, D.C. is feeling the brunt of the stalemate, with Hawaii listed second because of the large number of federal workers. So as the federal government shutdown drags on, some states are feeling the pinch a lot more than others, and the nation's capital is the most affected region. On October 15th report from Wallet Hub indicates that some 900,000 federal employees have been furloughed, while another 700,000 continue to work without pay. Essential services such as air traffic control and military operations are continuing. The data shows that Washington, D.C. is experiencing the brunt of the stalemate, given that 25% of all jobs there are related to the federal government. The district is also home to the highest number of federal contract dollars per capita, which translates to an impasse on many ongoing projects. In addition, the capital has the second highest number of residents enrolled in the Supplemental Nutrition Assistance Program, also known as SNAP, which is still operating but runs the risk of losing all funding if the deadlock continues much longer. Hawaii is listed as the second most affected state, also because of its large number of federal workers. About 5.6% of all jobs in Hawaii are federal positions. Real estate comprises nearly 23% of Hawaii's gross state product. So we're here some more about that. New Mexico is listed as the third state most affected by the government shutdown, as it receives more than $6,000 per capita in federal contracts. And then other states hurt the most by the shutdown include Alaska, Maryland, Virginia, West Virginia, Alabama, Oklahoma, and Arizona. Meanwhile, Minnesota, Iowa, Indiana, Nebraska, and New Hampshire represent the top 5 states that are least affected by the shutdown. So again, I thought some interesting notes there on that. Now, what does Polymarket think? So let's take a look here. What are the betting odds here on Polymarkets? Now, like I said, when this started 2 weeks ago, I basically said that I did not think that this was going to end quickly. I shown everybody a couple of articles, Vice President J.D. Vance, a couple other people basically saying that they felt that this was going to be over within a couple of days. I didn't really see that. I thought that I gave my rationale, basically saying that the magic number is 61 days. If they want to, they just said here that you've got 900,000 jobs have been furloughed, and another 700,000 are basically people continuing to work without pay. Well, if you in the federal government, if you're going to eliminate employees, there is a process with that. First they have to be furloughed, then you have to file, I think what's called the RFIs, and then like I said, it takes 61 days. That's the magic number for that stuff to go through. So I said that hey, there is a chance. Now the longest shutdown on record was 35 days. We are quickly approaching that. And and basically my theory was that that this lockdown would continue as long as the polls and everything are showing that, basically that the Republicans aren't being dramatically hurt by this. If that continues, the lockdown will continue. So in other words, if people think that if the Republican base thinks that they're in the right here and that they're making good use of this lockdown, i.e. they are cutting jobs, reducing the spending, like in other words, going back to the dead hot clock here for a second, the U.S. federal budget deficit, has come down from about, just about 2.1 trillion to now about 1.763 trillion. So again, that's not like I would have liked this number. I would like that number to have been cut in half. I liked it to have come down to $1 trillion. That hasn't happened, but that's okay. But we're making progress here. And I think that's what again, their voting base, that's what they want to see. They want to see progress. And I think if they continue to see that, they're going to be fine with letting this thing roll for a little bit longer. But I put a big caveat in there because at some point the lockdown does start to hurt people, and you have to acknowledge that. So it can't go on forever. So you have to have some kind of end game in mind here. Now, the betting odds are that right now it's at 82.2% that this is going to go beyond 30 days. That's the betting market right there. So we're going beyond 30 days here, which I think is almost locked in at this point that we're going to go beyond 30 days. So the question is, are we going to tie the record of 35? Or are we going to go beyond that? We'll see. But do I see this thing ending in the next 2 weeks? Maybe. I think there might be after this whole nonsense, this whole non-Kings rally thing this weekend, I think maybe next week there might be a chance that something starts to move, and that within, the next 2 weeks, by the end of the month, we come to a conclusion on this thing, maybe. But we'll see. We'll see what happens there. But so far, my theory of the case is playing out. Where again, the betting odds here have this going at least 30 plus days. And like I said, as long as the polling and the popular opinion continues to hold in favor, like I said, I think this thing will go on until basically Republicans get what they want. But we'll see. We'll see. Again, we'll continue. We'll see what happens. Now, as I was saying about the shutdown potentially hurting the economy, sure enough, I got this article here. So shutdown starting to harm the economy, says Treasury Secretary. So he said that a dirty secret is that some media outlets have been downplaying the shutdown's impact on the economy. So Treasury Secretary Scott Bessent said on October 13th that the ongoing government shutdown has begun to impact the U.S. economy as it enters its 13th day with no end in sight. In an interview with Fox Business, he said that the shutdown's true impact on the economy is not being fully covered by media outlets. I think the dirty secret here for why this has dragged on for so long is the Democratic friends in the mainstream media have been downplaying the shutdown. And this is getting serious, Bessent told Fox's Maria Bartiromo. The shutdown, which started on October 1st, is now starting to affect the real economy. It's starting to affect people's lives, he said, although he did not elaborate. Congress failed to pass a stopgap funding measure before the shutdown was initiated, with Democrats saying that any measure to reopen the government should require an extension of healthcare subsidies and the insane $1.5 trillion of ridiculous spending that they want that we can't afford and don't have the money for. They conveniently leave that little part out. And again, and don't forget, they want the healthcare to support illegal immigrants. That's a big part, not all of it, but that's a big part of it. So again, the answer to that is just, it's a hard no. No. Okay, now moving on now here's interesting. So JP Morgan this week launches a $1.5 trillion security initiative to boost America's critical industries. So the initiative comes as rare earth tensions with Beijing deepen and as Washington accelerates efforts to secure critical resources. So JP Morgan Chase has unveiled a $1.5 trillion investment plan to bolster core U.S. industries such as energy, defense, and advanced technology, calling it essential to restoring U.S. industrial strength and resilience. Under the 10-year initiative announced on October 13th, the bank will facilitate, finance, and invest in industries deemed vital to U.S. security, including advanced manufacturing, defense technology, energy infrastructure, critical minerals, and frontier fields such as artificial intelligence and quantum computing. It has become painfully clear that the United States has allowed itself to become too reliant on unreliable sources of critical minerals, products, and manufacturing, all of which are essential for our national security. Jamie Dimon, CEO of JP Morgan Chase, said in a statement, "Our security is predicated on the strength and resiliency of America's economy." The move comes amid escalating tensions with China over supplies of rare earth minerals. materials essential to everything from fighter jets to semiconductors. U.S. President Donald Trump recently threatened an additional 100% tariff on Chinese goods and export controls on critical software in response to what he called Beijing's hostile escalation of weaponizing rare earth exports. With China controlling more than 90% of global rare earth refining capacity, the White House has launched a push to rebuild the domestic critical minerals industry, fast-tracking permitting for critical mineral mining projects and pledging hundreds of millions of dollars to U.S. producers as it seeks to break Beijing's grip on supply. So as part of JP Morgan's new push dubbed the Security and Resiliency Initiative, the bank will deploy up to $10 billion in direct equity and venture capital to help U.S. firms scale production and secure domestic supply chains, spur innovation, and accelerate strategic manufacturing. The plan is organized around 4 key themes and 27 targeted sub-areas ranging from critical minerals, nanomaterials, and shipbuilding and pharmaceutical precursors to munitions, hypersonic systems, nuclear energy, battery storage, cybersecurity, artificial intelligence, and quantum computing. JP Morgan said the initiative will focus on reshoring advanced manufacturing, strengthen defense industry capacity, and advancing frontier technologies, all of which are key to bolstering U.S. economic and military power. The bank said it had originally planned to deploy roughly $1 trillion over the next decade in support of these sectors, according to previously undisclosed internal figures, but is boosting that commitment by 50%. Alongside the capital surge, JP Morgan is pressing lawmakers to cut red tape and advance education reforms to ensure the skilled workforce needed to sustain industrial revival. So this is enormous. This is a game changer. I mean, to have JP Morgan stand up and basically say that they're going to invest $1.5 trillion an initiative to boost America's critical industries. I mean, this is just this is great news. And I think it's awesome that they are stepping up to do this. I mean, it really is fantastic news. And I was kind of surprised this week that the market didn't get more of a bump on this news. I think this was released on Monday. This was released on Monday. So I was really surprised that the market didn't get more of kind of an uplift or a boost from this. But and it could be because of what I'm about to show you with some of the other trade news for this week. So let's go into a few of these trade articles here. So Treasury Secretary Bessent says a stock market decline won't deter the U.S. from taking strong action against China. So Treasury Secretary Scott Bessent insisted that the U.S. won't change its negotiating stance on China due to stock market volatility. His comments came as the stock market has whipsawed in recent days as the status of ongoing trade talks between the world's largest economies appeared to teeter. Bessent also pushed back on a report in the Wall Street Journal overnight that President Xi Jinping is betting that the U.S. economy can't absorb a prolonged trade conflict with Beijing. So again, very interesting comments coming out of the Treasury Secretary there. Trump administration will set price floors across a range of industries to combat China, Bessent says. So the U.S. Had to use industrial policy to compete against non-market economies like China. Treasury Secretary Scott Bessent told CNBC the Trump administration will set price floors across a range of strategic industries to combat Beijing. The administration could take equity stakes in more companies in the wake of China's new restrictions on rare earth exports, he says. So the Trump administration will set price floors across a range of industries to combat market manipulation by China. China has driven foreign competitors in the rare earth industry out of business over the past 2 decades by using its global dominance in refining and processing to slash prices. When you are facing non-market economy like China, then you have to exercise industrial policy, Bessent told Sarah Eisen at CNBC's Invest in America forum in Washington, D.C. So we're going to set price floors and the forward buying to make sure that this doesn't happen again, and we're going to do it across a range of industries, the Treasury Secretary said, without naming any specific industries the administration was looking at beyond rare earths. The U.S. also needs to set up a strategic mineral reserve, Besson said. So JP Morgan Chase is interested in working with the Trump administration to create such a reserve. Yes, that would be good. Rare earths are used to produce magnets that are critical inputs in U.S. weapon systems like the F-35 warplane and Tomahawk cruise missiles. Rare earth magnets are also essential for civilian commercial applications like electric vehicles. So again, very, very interesting. So we're going to set these price floors across a range of industries. Now, China, on the other hand, China comes back and China accuses the U.S. of deliberately causing panic over rare earth controls and said it is open to talks. China's Ministry of Commerce accused the U.S. of creating panic over Beijing's controls on rare earth exports. Ministry of Commerce spokesperson He Yongquang said China was open to trade talks with the U.S. The U.S. Trade Representative Jameson Greer accused China of trying to control the world's technology supply chains in an interview with CNBC. So absolutely, is China trying to control the supply chains? Yes, 110%. Yeah, they absolutely are trying to do that. And this is a matter of national security for the United States because they need these rare earth minerals. They need these rare earth materials. They need them to build magnets first and foremost. But our military depends heavily on these things in order for us to be able to make ammunition, to be able to make missiles, to be able to do all this stuff. We need all these rare earth materials. China knows this. And they're holding it back on purpose because they know that they can use it to fill their coffers, but we're kind of hard pressed here. And again, and it's a time issue, right? It's all about time. They know that right now they have time on their side because we do have access to rare earth rare earth materials, rare earth minerals here in the United States. We have access to these things. However, it would take us time to ramp up production. And then we also have a lot of environmental roadblocks in the way there. We have certain states that don't want companies in there, digging and mining and doing all this stuff, whatever. So we have different roadblocks. In China says, hey, you go over here, you dig this, start digging up these materials here. We don't care about the environment. We don't care about any of this stuff. Just go do it. And then they go do it. We can't, unfortunately, it's a little bit harder for us to do that here in the U.S. All right, but let's keep rolling on this. So U.S. may decouple from China, the big word, the D word, decoupling. The U.S. may decouple from China if rare earths dispute persists, said Secretary Scott Bessent. Scott Bessent said a lot this week, man. He did doing a lot of talking, a lot of interviews this week. The Treasury chief said Beijing's rare earth export curbs are testing the world's tolerance. So remarking on the ongoing U.S.-China dispute over rare earth exports, Treasury Secretary Scott Bessent said during an October 15th press conference that if Beijing refuses to act as a reliable trading partner, the United States and its allies may have no choice but to decouple. While emphasizing that decoupling, severing trade ties entirely or nearly so is not Washington's desired outcome. Bessent said it could become unavoidable given China's posture in the current standoff over rare earth supplies. He noted that U.S. auto manufacturers have recently reported slow shipments of China-made magnets containing rare earth elements, with Chinese officials offering non-credible explanations for the delays. If China wants to be an unreliable partner to the world, then the world will have to decouple, Bessent said. The world does not want to decouple. We want to de-risk. But signals like this are signs of decoupling, which we don't believe China wants. And again, we do not want to decouple. We should work together to de-risk and diversify supply chains away from China as quickly as possible. Yes, I agree with that 100%. And again, I'm all for the decoupling, okay? But you have to also realize what comes along with that. There's a big price to be paid for that in the short term. But to restore our manufacturing base, to restore our national security, to restore the fact that we can get things done and made here without having to rely on the rest of the world, like that's the ideal thing. That's what we want to have happen. So, but okay. Treasury Secretary Scott Bessent was supposed to speak with his Chinese trade counterpart today on Friday. Not 100% sure if that meeting did in fact take place. I'm assuming it did, but Treasury Secretary Scott Bessent will speak by phone on Friday with Chinese Vice Premier He Lifeng. A Trump administration official told CNBC's Iman Javers the conversation could signal progress after President Donald Trump reacted to Beijing's new export controls by threatening an additional 100% tariff on Chinese imports. So, okay. And then I think this is the last thing I have on trade. And then I have a couple of crypto related articles that were very interesting. But the U.S. will not adhere to a global carbon tax on shipping, said Trump. The International Maritime Organization was set to vote on a tax proposal on October 17th. Yes, this is nuts. This is basically the globalists gone nuts with, again, their environmental schemes where they're just trying to force a tax upon us. They're trying to force us to pay our tax dollars to pay for their crazy environmental schemes over in Europe. And the hard answer to that is no. That is a hard no. No, we are not going to be subject to a global carbon tax. I don't think so. That would be a big no. The United States will vote no to a global carbon tax proposed by the International Maritime Organization on October 17th. President Donald Trump said on Truth Social, "I am outraged that the International Maritime Organization is voting in London this week to pass a global carbon tax," he said in the post on October 16th, urging others to reject the proposal. The United States will not stand for this global Green New scam tax on shipping and will not adhere to it in any way, shape, or form. We will not tolerate increased prices on American consumers or the creation of a Green New scam bureaucracy to spend your money on their green dreams. Yes, I couldn't have said it better myself. The net zero framework proposed that was put before the UN agency specializing in regulating maritime transport would require ships to comply with a global fuel standard for large and ocean-going vessels 5,000 tons or larger to force the shipping industry's green gas emissions down to net zero by 2050. The president's opposition for the tax proposal followed a statement his administration made on August 12th. So so that is an absolute no-go, and happy for it. But but we'll see what happens. I mean, Europe's doing a lot of nutty things these days. They're doing a lot of nutty things. So we'll have to see what happens here. We'll have to see how this one plays out. So, all right, here's a couple of very interesting things. So obviously last week we had what I perceived as basically the kickoff of the Chinese-U.S. global trade war. And there was a massive repercussion in the crypto market to this last weekend. So here's what investors need to know about the weekend's massive crypto rout. So the price of Bitcoin briefly sank below 110,000 on October 10th amid what traders are calling the largest single-day liquidation event in crypto history. Lesser-known coin prices fell 80% over the weekend, and crypto-line stocks are swooning so far on Tuesday. So the U.S. China trade tensions triggered a sell-off in Bitcoin and altcoins on Friday. Now the industry is calling it the largest single-day purge in crypto history. More than 19 billion in leveraged crypto bets were liquidated over a 24-hour period that ended Saturday evening, affected some 1.6 million traders, according to research platform CoinGlass, which called its estimate conservative and the real total likely much higher. Bitcoin, which had been grinding higher on the so-called debasement trade, diverged from gold as Beijing placed new restrictions on rare earth mineral exports and subsequently pushed President Donald Trump to threaten a 100% tariff on China. As the market digested the renewed trade spat, Bitcoin stopped holdings hands with gold and followed risk assets like stocks lower, pulling back from a recent record. The concern over an increase in tariffs were undeniably the catalyst. The crypto market's operational quirks fanned the flames when traders rushed the exits at a time when there was less liquidity. The added selling pressure ripped through coin prices. Though crypto markets do not close, trading volumes tend to wax and wane alongside the U.S. stock market hours. And Bitcoin fell briefly below 110,000, but I believe it's back up. Yeah, it says right here, Bitcoin was recently back above 112,000, for example. But again, very interesting developments here in the crypto market. I mean, obviously, just a massive sell-off. And then here's another article that was in the Wall Street Journal, and this was a historic crypto sell-off. Erased over 19 billion, but two accounts made 160 million. So it was very interesting. So total liquidation on crypto derivatives exchange daily. So on September 7th, El Salvador makes Bitcoin national currency. On November 8th, 2022, FTX exchange collapses. October 10th, 2025, Trump's surprise announcement of 100% tariffs against China. And so, again, you just see these total liquidations on crypto derivatives exchange. Again, the El Salvador makes the Bitcoin national currency. You can see that massive spike there. But let me look at that. Look at how tiny the FTX exchange collapse is to this Trump announcement, 100% tariffs on China. I mean, that's unreal. Just looking at that chart, it's just, I mean, that's crazy. So President Trump's surprise announcement of 100% tariffs against China on Friday triggered a cryptocurrency sell-off that wiped out more than 19 billion in leveraged positions. Two accounts that placed bets against the market minutes before the news broke scored a 160 million windfall. Bitcoin dropped 12%, forcing liquidations that triggered even more selling, pushing prices lower. Less popular tokens saw declines as steep as 80%. So CoinGlass, a crypto data platform, noted that the scale of the sell-off is likely underreported, as many platforms don't publish liquidation data. While crypto has fallen before, analysts said the sharp downturn exposed the extreme leverage that had fueled a months-long rally, which began after the election of an administration seen as friendly to the industry. So again, you kind of see this massive plunge off here between October 9th and October 11th. But then you begin to see it bounce back here over the last couple of days. But, again, just very interesting stuff there on the crypto front. So, okay, I'll get back into the Fed stuff here in a minute. So first I want to take a second. So this is the point of the program where I usually like to share a couple things with you guys. I like to go over economic indicators that should be coming out, but may not necessarily because of the lockdown, or not the lockdown, the shutdown rather. Sorry, not a lockdown. Don't want a lockdown. All right, and then I like to talk about the episodes that I put out this week. So let's start with the economic indicators, shall we? So on Monday, October 20th, we get the U.S. leading index. On Wednesday, October 22nd, we get the 20-year Treasury bond auction. On Thursday, October 23rd, we get continuing jobless claims. We get initial jobless claims, existing home sales, and then we get the 5-year tips auction. And then on Friday, October 24th, we get the core CPI, manufacturing PMI, services PMI, Michigan consumer sentiment, new home sales, and the U.S. Baker Hughes oil rig count. Now, I will say I believe we will get the CPI numbers on Friday, because they did make the announcement the other day that basically the Bureau of Labor Statistics, which puts out the CPI, that they had a bunch of employees that were going back to work. So again, we should see those CPI numbers. So, but I'll keep you posted on that. So, all right, let's look at what were the episodes that I put out this week. So, I do want to add a little caveat here. So if you did going back to last Friday, I did an episode, Fitch Ratings warn about the systemic shock to private credit. So that, ties into the whole conversation we had for the first 40 minutes tonight on basically the meltdown in loans to regional banks, the private credit market, so on and so forth. A lot of that ties back into that episode. So if you did not get a chance to see that episode, go back and watch it. I promise you'll learn a lot from that episode. So, but the first episode that I put out this week on Monday was all related and ties into First Brands. So First Brands Group files for bankruptcy. Private credit market in trouble? ? First Brands Group filed for bankruptcy with $2.3 billion missing and a criminal investigation being started. First Brands Group is the second major failure in the auto industry within the last month, following the bankruptcy of Tricolor Holdings. Both companies are tied to the private credit market. First Brands Group appears to have committed major fraud, and like Tricolor Holdings, is pulling in a list of major banks, including BlackRock, Carlyle, UBS, Cantor Fitzgerald, Jefferies, etc. Are these the first dominoes in the collapse of the private credit market? Makes you think. So that episode examined a series of articles coming from the Epoch Times, the Wall Street Journal, the Financial Times, Barron's, and CNBC. Then on Tuesday, I talked about the big M&A transaction that was just announced. Basically, so Fifth Third Bancorp buying Comerica in a big $10.9 billion bank M&A deal. This is the largest bank M&A transaction since 2021 and one of the largest bank deals since 2009, being that it is over $10 billion in value. This episode examines multiple articles from S&P Global. As the bank M&A market is heating up, strategies are also forming for regional banks like PNC as they try to solidify specific markets in the U.S. In addition, this episode also provides an update on the overall bank M&A market and the global M&A market. So if you want to get a little bit more background on what is currently happening in the bank M&A market, go check out that episode there. It's a good one to check out. Then on Wednesday, I did a review of ICBA advocacy and action for the fourth quarter of 2025. So that is a great little 2-page PDF that I love to cover with everybody. It's put out on a quarterly basis. And that, PDF, it just goes over what are all of the hot button regulatory topics in the banking industry right now. So that episode examined the ICBA advocacy and action for the fourth quarter of 2025. It's a quarterly publication from ICBA, which covers all the hot button regulatory topics in the banking industry. Regulations covered include the 1071 rule, deposit insurance, digital assets, regulatory framework, trigger leads, ACRE implementation, 1033 rule, and GSEs. So definitely, if you want, again, just a quick snapshot of what's going on in the banking business from a regulatory perspective, go check out that episode. Then on Thursday, I did Are Consumers Shifting to the quote unquote the super app? So the rise of the so-called super apps that help small businesses to manage messaging, financial services, payments, and provide other tools could change the game for how banks manage their own applications. Think of WeChat. So like WeChat in China has been the prototype as the so-called do everything app in the world. But now WhatsApp, Google, and X are all in on trying to create their own super app here in the US. What can banks do to compete in the super app market? Well, this episode examines a blog post from PCBB that looks at that issue. So again, I think it's very interesting when you think about this whole concept of the super app. I mean, Elon Musk has been talking about this for years. He wants to turn X into an app very much like WeChat, like in China. Like he wants to make it the all everything app. I think that is very difficult to do because, I'm a prescriber to, you can't be all things to all people, that, you have to have some kind of niche, in your business. And, so again, trying to be, again, I go back to in the 2000s, banks had this whole concept of like what they called universal banking, where banks really, it was like, oh, we're going to be everything to everybody. And it really did not work out that way. It really did not play out that way. And so again, could we see something like this again? I mean, you got Google's working on it. X is working on it. You got a couple of players out there right now that are working on this thing, trying to make this come to fruition. We'll see if that, does or does not happen. And then finally on earlier today, I came out with how can bank boards deal with shareholder activism? So with bank M&A market heating, with the bank M&A market heating up, shareholder activism could be on the rise. This episode examines a recent article from Bank Director titled "Shareholder Activism Could Heat Up Should Boards Fight Back." So with the recent announced acquisition of Comerica by Fifth Third Bank, it was revealed that an activist investor played a role in pushing Comerica to seek the sale of the bank. So what can banks do if faced with an activist shareholder? So this article offers several strategies that a bank board can implement, along with considering whether or not they should be combative. So again, just a very interesting article. I think shareholder activism, particularly in the banking space, can get very interesting. It can get very, nasty in certain regards. So again, something to keep an eye out on there for us. So keep an eye out on that. Okay, so those were the episodes that I put out this week. Let's go into a little bit of banking news, shall we? So, mortgage rates down. As I said at the beginning of the show, I showed you how the 10-year Treasury had, come down to around 4%. So the rate for the 30-year mortgage rate averaged 6.27% this week, down from 6.3% last week. 15-year ARM average, or the 15-year mortgage, was down to about 5.52, just slightly down, but obviously 6.27% this week, getting a little bit closer to what we're looking for. Builder confidence rises in October. OCC released their updated interest rate risk statistics report for the fall of 2025. I will cover that in an upcoming episode. FDIC announces new process for non-banks to bid on failed large banks. So the FDIC announced that it has developed a pre-qualification process for non-bank bidders with the intent of qualifying non-bank bidders in advance of any offering. So yeah, so very interesting. B2B payments, I covered that earlier. ICBA and others file court brief in case on Fair Housing Act statute of limitations. So ICBA and other groups filed a friend of the court brief asking the Supreme Court to hear a case that would resolve a circuit split created by the Second Circuit's adoption of an equitable tolling standard, which departs from prior Supreme Court precedent and effectively overrides the 2-year statute of limitations set by Congress for Fair Housing Act claims. So yeah, okay, so we'll see what happens with that. Agencies withdraw principles from climate-related financial risk management. So yeah, I'm going to talk about that a little bit more here in a minute when we get back to the articles. The October 2023 principles were intended for financial institutions with more than $100 billion in assets, though ICBA expressed concern with their potential impact on community banks, given language in the principles describing all financial institutions. So the OCC withdrew its participation from the principles earlier this year. So love to see it. Fantastic. The New York Fed survey, business increases in October. So business activity increased modestly in New York in October. Mortgage applications dip in latest weekly survey. Economic activity largely unchanged, according to the Beige Book. And the KFC Fed launches Ag Resources. So the Federal Reserve Bank of Kansas City unveiled the Center for Agriculture and Economy. So the KC Fed said the center will provide timely analysis of industry developments and conduct ongoing research on the agricultural economy. So FHFA seeks input on strategic plan. Okay. ICBA discusses 1033 rulemaking and meeting with the CFPB. So the senior ICBA staff met with the Consumer Financial Protection Bureau leaders to discuss its Section 1033 rulemaking. That is open banking. Another thing I've preached endlessly about this year, rulemaking on sharing consumer financial data. ICBA met with Mark Calabria and CFPB staff to discuss expanding the exemption threshold to $10 billion, limiting the universe of potential third parties data can be shared with, allowing banks to charge a reasonable fee for data access, and shifting financial liability for breaches to third party where the breach occurs. So, but again, I am vehemently opposed to open banking. I don't want it. No way, no way, no how. And, again, I hope that something can be figured out with that, because that is not a good thing there. I would really prefer for the 1033 rule to just be scrapped altogether. but I don't know. Apparently, they're going to work on rewriting it, which again, I'm not crazy about that. So, ICBA urges senators to prohibit payment of interest on stablecoins by all digital market participants. So ICBA and its 44 affiliated state partner associations urge senators to ensure proposed legislation to create a regulatory framework for digital asset markets does not impair community banks' ability to utilize deposits to fuel their communities. So very interesting. Obviously, banks are very concerned with the Genius Act and how that may enable if you're issuing stable coins, that the stable coins could potentially earn interest. They don't want that to happen, because if they do that, then that could potentially suck deposits out of banks or suck deposits over to, stable coins. New op-ed spotlights data showing harmful impact of credit union acquisitions. So a new op-ed from ICBA leadership bankers says that public data show why policymakers should re-examine the impact of federal tax subsidies on credit union acquisitions of community banks. Jeremy Powell, navigating data delayed due to shutdown. So while some important government data have been delayed due to the federal government shutdown, available data indicate the outlook for employment and inflation has not changed much since the Federal Open Markets Committee September meeting, Federal Reserve Jeremy Powell said. So speaking in Philadelphia, Powell said, data available prior to the shutdown suggested growth in economic activity may be on a somewhat firmer trajectory than expected. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Inflation data are up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Federal agencies target transnational cybercrime networks. So you got that. Independent banker shares fraud-fighting strategies in one of their magazine articles. Okay. Consumer sentiment remained unchanged in October. Former FDIC chair, help for community banks must be a higher government priority. So community banks are the crown jewel of America's banking system, but they face disproportionately harsh regulatory burdens, says former FDIC chair Sheila Blair wrote in an op-ed in American Banker. Fed releases frequently asked questions templates on mutual bank capital. So it's interesting stuff there. ICBA thanks Bessent and Michelle Mickey Bowman for pro-community bank remarks. ICBA thanked Treasury Secretary Scott Bessent and Federal Reserve Vice Chair for Supervision Michelle Mickey Bowman for their pro-community bank remarks at last week's Federal Reserve Community Bank Conference. Senate votes down ICBA opposed amendment to ban interest on reserves. So the Senate last week voted against an ICBA opposed ban on interest on reserves to the National Defense Authorization Act. So again, not great news there. ICBA supports bill to improve deposit insurance system. So ICBA expressed support for deposit insurance reform legislation it said is an important start to strengthening the national deposit insurance system that minimizes additional costs for community banks. So so we'll keep an eye on that one. Hopefully that plays out. Because again, they're looking to provide expanded deposit insurance coverage of up to $10 million per depositor for deposits held in non-interest bearing transaction accounts. So that would be obviously a game changer. That'd be a big thing. And then ICBA urges policymakers to support CDFIs. ICBA expressed concerns with actions to dismantle the Community Development Financial Institution Fund following reports of Treasury Department actions to abolish the fund. Well, part of the problem here is that apparently the CDFI fund was being abused in a lot of ways that it shouldn't, or being abused in a lot of ways that it shouldn't have been. And unfortunately, for a lot of good regular people that were getting loans and were getting support from the CDFI fund, they're getting hurt by some of the bad apples running around there doing different things. So okay. All right, guys, that's the banking news that I have for everybody there tonight. We're going to get into some more stuff here in a minute, but First, I wanted to do something that I've been meaning to do here for a couple of weeks, and that is I just wanted to take a couple of minutes real quick, and I wanted to show everybody just some of the books and stuff that I'm looking at here recently. So, Money GPT, AI, and the Threat to the Global Economy by James Rickards. So if everybody wants to go back, I did a Labor Day special back in September where I basically, it's a little bit longer of an episode. It's about 45 minutes or so, but I basically read through chapter 2 in the book, which is called Banking Mythos. And it basically gets into an unstoppable bank run that could be brought on by AI in the financial system. And the first chapter of the book actually talks about a financial stock market crash brought on by AI and being used in the financial system. So some James Rickards, as always, he's put out some really good books in the past. This book was absolutely phenomenal. I would highly recommend it to anybody out there that would be looking at for something interesting to read on the kind of the cross section between AI and finance. Another book I'm reading here is called The Thinking Machine. This is basically Jensen Huang, NVIDIA, and the World's Most Coveted Microchip by Stephen Witt. So far, not completely done this book, but so far it's very good. Basically a whole background on NVIDIA and Jensen Huang and basically his story, how he created the company, how it grew up. And I mean, I've pretty much lived the rise of NVIDIA, and have been very, very much aware of this company for anybody who played video games on PCs or was even somewhat familiar with video game graphic cards or what are also known as accelerators would be very knew who NVIDIA was. It's just that the rest of the world blew up as NVIDIA chips became super popular for AI. Another interesting book on AI that I just came across here was called this. If anyone builds it, everyone dies. Kind of why superhuman AI would kill us all. And this is written by Eliezer Yudkowsky and Nate Soares. But again, a very, very thought-provoking book on basically AI super intelligence and what that could mean for everybody. Again, if anyone builds it, everyone dies. So again, very interesting book there. And then finally, this book was recommended to me by a great gentleman who I'm going to be having an interview with very shortly here in the next couple of weeks. I'll be having an interview come out with everybody. But Storytelling with Data. Very, very interesting book here. A data visualization guide for business professionals. And this is from Wiley. But again, it seems like a phenomenal book, Storytelling with Data, and just a phenomenal book on basically how to better use data to tell stories, how to better visually. I think again, one of the things is if you work with data all the time and you're trying to use that data to tell a story, to illustrate a story, visualize a story for people, it's again, great book there to look at. But that book came highly recommended from the gentleman I'm going to do an interview with. We're probably going to talk a little bit more about that book when we do the interview. So keep an eye out for that one, because that one will be coming there. But that is just, again, some of the books I want to look at. Oh, and then I got one other one here. So I'm going to do something here in honor of the passing of Charlie Kirk. He wrote a book that I had for a number of years called The College Scam. And when this book first came out, I was very interested in it because I was curious as to some of Charlie's points. Why did he feel college was a scam? Why did he feel, college wasn't worth the price? So again, I'm going to be doing a couple episodes where I'm going to take a deep dive on the college scam, and I'm going to take a look at that because I think that, again, going through some of the rationale in the book, I mean, there are some very, very valid points made by him in this book on the whole notion of the college scam and what's going on with that. So again, that's something I will be covering here in the future. So, but anyway, All right, let's get back to some of these articles here as we continue to roll on here tonight. So let's go. We're going to run through a few more things here. So Fed Governor Stephen Miron wants a half-point cut this month, while Waller backs another quarter-point move. So Fed Governor Stephen Miron said Thursday he plans to repeat his push for a half percentage point interest rate cut when the central bank meets later this month. Governor Christopher Waller advocated a quarter-point reduction at the meeting later this month, a position that appears more in line with the Fed consensus. Earlier this week, Federal Chairman Jeremy Powell indicated that a softening labor market kept the door open to additional easing. Now, again, I last week's show, I presented everybody with a number of articles from a number of different Fed governors, and basically, the 4 or 5 of them were all saying that, yeah, they were in favor of the quarter-point rate cut, but they didn't really see the need for additional rate cuts moving forward. So the question becomes, where do we really end up? It really seems like the Fed is, split 50-50 between those wanting to cut rates and those not wanting to cut rates. So again, I think the market, and I'm sure these articles will come out here in the next week or so. I'm sure the market is very, probably 70-80% that we're going to get another quarter-point rate cut here at the next Fed meeting. But we'll see. I think it's a little bit of a toss-up, and then of course there are some Fed governors, and I agree. And again, just to say here, I agree 100% with Stephen Miron. I think we should get a 50 basis point rate cut, and the reason why I say that is because I think the Fed should have been cutting 6 months ago, and they've waited too long to start making these cuts, and so I think they do need to be a little aggressive right now and get this down. And I'll say this too. I think it says in here that he would like to see. I thought he said, yeah. So Waller points to 2 scenarios, one in which gross domestic product continues its upward climb and the labor market improves, in which case the Fed would need a more cautious approach on cutting, and the other in which the economic picture darkens and additional rate cuts on the order of up to 1.25 percentage points are necessary. So in other words, we've already got 25 basis point rate cut. They're talking about an additional 125 basis points. So basically bringing the rate down in total 150 basis points. That's where I think we need to go. That's where I think we need to be at. I think that is the sweet spot for us, is being down about 150 basis points from where we're currently at with the federal funds rate. That would take us down to about a 3% Fed funds rate. And I think that's really where we need to be. And again, all the stuff, remember all the stuff we talked about earlier tonight with the deterioration of the credit, market in the banking system, the trouble that regional banks could get in. If we continue to see a deterioration of the labor market, and basically we continue to see a deterioration of the credit market for banks, particularly regional banks, that is going to make the cutting of the rates all the more important. So, but we'll see how this continues to play out. I'll bring you guys the news when we have that Fed meeting here in the next week or so. So U.S. regulators end climate oversight framework for big banks. So the agencies are scrapping the 2023 climate guidance after government officials said the regulation should focus on core financial risks, not on climate policies. Yes, I could not agree more. Federal regulators will no longer require banks to spell out how they manage climate-related financial risks, following objections from officials in the Trump administration and Republican lawmakers who said that climate policy was distorting financial regulation. In a joint move announced on October 16th, the Federal Reserve, the FDIC, the Office of the Control of the Currency, the OCC, rescinded a set of rules called the Principles for Climate-Related Financial Risk Management for Large Financial Institutions. Introduced in 2023, the rules applied to banks with more than $100 billion in assets, basically meaning the top 14, banks in the country. And were intended to incentivize institutions to integrate climate considerations into governance, scenario analysis, and risk oversight. So in other words, ESG. Regulators said the withdrawal reflects a return to longstanding safety and soundness standards that already require banks to manage all material risks without singling out climate. The agencies do not believe principles for managing climate-related financial risks are necessary, the notice stated, while the Federal Reserve memo further clarified that such guidance risked distracting banks from focusing on core vulnerabilities such as credit, liquidity, and operational risks. Yes, I couldn't agree more with that. I think that is very, very good news. All right, now I want to show everybody a series of 3 articles here on potential changes to bank regulation. The things that's basically been talked about now for the last 9 months are potentially coming to fruition. We'll see here. So the FDIC weighs looser requirements for de novo banks and failed bank bidders, Hill says. So in other words, de novos meaning startup banks. So the FDIC is considering whether to loosen requirements for de novo banks and failed bank buyers while establishing new supervisory processes around stablecoin issuers. In dual speaking engagement October 15th, just weeks after President Donald Trump nominated him for a full term, acting FDIC Chair Travis Hill said the agency is weighing looser requirements for de novo banks and failed bank buyers while establishing new supervisory processes for digital assets. As part of the FDIC's efforts to improve its bidding process for failed bank acquisitions, the agency is reevaluating its bidder eligibility criteria to maximize the number of bidders while ensuring they have the capacity to take on such a transaction. Our existing criteria is too restrictive when it comes to large failures. The downside risk of not finding an acquirer or of the best bid coming at a substantial cost to the deposit insurance fund may outweigh the downside risk of potential future problems at certain potential bidders. On the de novo front, another priority for the FDIC is restarting the pipeline of de novo banks in the U.S., noting that de novo activity has fallen off a cliff since the 2008 financial crisis. Yes, absolutely. So the FDIC is still in the policy development phase regarding de novos, and while banks should still meet a high bar to get deposit insurance, the agency is looking into how it can be more flexible with its expectations around management and capital. In order to have a meaningful pipeline, we do need to have more flexibility and try to encourage more interest in activity. And then they get into stablecoin custody. We'll kind of skip that for the moment. The next one here, community banks plead for regulatory relief from $500 million and $10 billion asset thresholds. Regulators agree that banks' asset thresholds need revamping, though they differ about the best way to do it. 2 of the industry's top regulatory voices support the raising asset thresholds at the Federal Reserve's Community Banking Conference on October 9th during a fireside chat. So Treasury Secretary Scott Bessent, who is at the helm of bank regulation during the administration, suggested asset thresholds need to be adjusted using inflation. Meanwhile, the Fed's top banker, Vice Chair for Supervision, Michelle Mickey Bowman, thinks a growth-based adjustment would work better. A simple fix would be for the policymakers to adjust the community bank and other thresholds based on growth and apply that adjusted threshold consistently, indexed to adjust for future growth, Bowman says. This approach would preserve the policy choice establishment when the threshold was initially set. Bessent agrees there needs to be a substantial increase, citing an example that a bank might not be able to take a big deposit because doing so would send it over $500 million in assets and bring on the regulatory compliance burden. Now, I do want to tell people this one thing here with this. The asset threshold, I don't really necessarily agree so much with the 500 million. I think the bigger threshold is 1 billion. $1 billion in assets. That's the bigger threshold. You have 1 billion, 10 billion, 50 billion, 100 billion. Those are the thresholds that you got to hit. And I don't know. They talk about sometimes like, oh, we use these calculations and stuff to come up with these thresholds, but I don't know. I feel like a lot of times like they just, well, yeah, $1 billion sounds good. Hey, 10 billion sounds good. I think they do need to move that up. I think that the $1 billion threshold should now become 5 billion. I think the $10 billion threshold should become 20 billion, and that 50 billion should maybe be moved to, 75 or something like that. Maybe 100 becomes 150. But there's no doubt that these thresholds need to be substantially moved up because what happens is, say you're a $1 billion bank. and you want to continue to just grow the bank organically. Well, when you cross that $1 billion threshold, you bring in hundreds of thousands of dollars of new regulation that the bank now has to absorb. And a lot of times the best way to do that is through mergers and acquisition. You acquire another bank that's 500 million, and now you make yourself a $1.5 billion bank, and then you grow to try to get to 2 billion. It's again, not that it can't be done organically. It's just a little bit tougher to do it that way. And again, by moving those thresholds, now you're making it easier for the banks just to continue growing without heaping this massive regulatory burden on top of them, and just making it much more difficult for them to grow and and basically forcing them a lot of times into a merger type situation where they may not want to end up in that. They might have a good bank, they might run a very, very, very good bank, and they don't want to end up in a merger and acquisition situation. So there's that. So, and then the final piece here was the OCC eases regulatory burden, saves community banks time and money. So after raising the community bank threshold to 30 billion from 10 billion, the OCC took steps to reduce the bank's regulatory burden through rule proposals and guidance, less frequent and burdensome exams, faster approval timelines for activities such as M&A and branching, and reduced risk model reviews are expected to save community banks time and money, sources told S&P Global. The changes are expected to benefit the 866 banks with under 30 billion in assets overseen by the banking watchdog. After raising the community bank threshold to 30 billion, the number of banks that will benefit increased by 16. The changes will help with the mental wear and tear of the regulators just leaning on you and holding you. The 2 billion bank to the same standard as the $100 billion bank. John Gorman, a partner at Lewis Gorman PC, who advises financial institutions on M&A and regulation, said in an interview. So it just has been making banking more difficult. Yes, I could not agree more with that. So they're definitely going to help out with examinations. It's fantastic news. It's really going to help. Lessen the exams, faster approval timelines for M&A and branching, reduce risk modeling reviews. It's just all of it, just fantastic. Just good stuff. Okay, all right. Just a couple more things here. Banking industry down but not out in the fight to end credit union tax exemption. So neither banks nor credit unions are backing down from the years-long feud over credit union taxation after the issue was left out of the landmark tax bill that Congress passed in July. So Congress previously weighed whether to tax credit unions to pay for tax cuts in the budget reconciliation bill, but legislators ultimately kept the tax exemption intact in the final bill. Now, here's the thing. I mean, I think they're going to have to address this at some point, right? Because there was one, I'm trying to think of the merger. There was one credit union merger that was just announced here in the last few weeks that, a massive credit union was established. I think a credit union that was over either up to or just over 10 billion in assets. I mean, and this bank is now this credit union is now operating in 10 states, has a ton of branches. I forget the exact number, has a ton of branches. But I mean, basically they're operating just like a bank, just like a large community bank. And the fact that they are, that not having to pay taxes is ridiculous. And I don't know what's up with that. So, but we will keep an eye on this one. OCC grants conditional approval for Erebor Bank's national charter application. So again, very interesting. Now, Erebor, this is for a national bank charter application. The bank based in Columbus, Ohio, will be a full-service insured national bank providing traditional and virtual currency-related products and services to businesses and individuals. It plans to hold certain virtual currencies in its balance sheet, according to a regulatory document. Erebor is the first de novo bank to receive a preliminary conditional approval since I arrived at the OCC, said OCC's Jonathan Gould in a news release. So again, very interesting. This bank and their business model, again, looking more toward virtual currencies and having those virtual currencies on their balance sheet. So again, very interesting stuff there. Dual stock and gold boom reveal divided economic outlook. So this was very interesting just because I just want to show everybody some of these charts on here. So look at the gold price. I mean, gold was up over, 5,300 this week. I mean, just crazy. And then you see silvers, silver is up over $50. I mean, just wild here. What's happening with gold and silver prices. I mean, you're just seeing them just continue to skyrocket. And I'll have more to talk about on this in later episodes over the next couple of weeks. A lot more going on with gold. Gold's record run could usher in biggest change ever to the market's classic 60-40 stock bond investment portfolio. So again, I've heard a lot of investment advisors talking about this lately. The so-called 60-20-20 portfolio concept recommends investors consider moving half of the classic bond allocation to an alternative like gold or Bitcoin. So very interesting conversation around that. I do have a couple articles related to that. So again, I'll talk about that more in later episodes. And then a couple things here on a couple articles here on CEOs here. So CEOs are tweaking hiring plans as economy hits a pivot point. So CEOs remain cautiously optimistic with 48% planning to increase headcounts. Tariffs have increased costs for 62% of businesses surveyed. 43% of companies report hybrid work models, while 45% are fully on site. So again, interesting information there. CEO confidence slips as 2/3 warn of stagflation, according to the survey. So the latest CEO survey found that the top fears among leaders include geopolitical instability and cyber threats. So interesting stuff there. And then last article I got here for you guys, small businesses are being crushed by Trump's tariffs and economists say it's a warning for the economy. So CNBC interviewed nearly a dozen small business owners to get a better understanding of how much tariffs are costing them and the impact the duties are having on their strategy and operations. Many of the small businesses said they've been forced to freeze hiring, pull back growth plans, take on new financing, or cut salaries to keep operations afloat. Now, do I believe that? I think there's a little bit of much in this thing because we're going to see here. Let's look at this first example here, and you'll see what I'm saying. The CEO of AV Universal Corp, a small footwear company that sells through retailers like Macy's. So footwear company, retail business selling through Macy's, Nordstrom, and DSW, said that they needed to take out a $250,000 loan to pay this tariff bill on a container of shoes he imported from India for the holiday shopping season. Varma didn't have the cash on hand to pay the duties, which he said usually to be around $7,500 for a similar size container before President Donald Trump's new tariffs. But without the financing, he wouldn't have anything to sell during the holidays. Now, this guy had to take on this line of credit at a 32% rate of interest and with weekly honorary weekly payments. So it sounds to me like he got this from an online lender like Blue Vine, Cabbage, so on and so forth. But here's the problem. Like this guy has a business model that is not going to work anymore. This is the thing that people have to learn. We are in a new paradigm now. There are tariffs again. There are trade conflicts again. The era of buying all this, getting all this stuff made in Vietnam and Thailand and India and China, like that era is coming to an end, and it's coming to an end very quickly. You are going to have to now get your stuff made in the U.S. because if he gets his stuff made in the U.S., how much tariff is he paying? He's paying zero. So zero tariff dollars. Okay, he's not going to have to pay that $250,000 if he gets the product made here in the U.S. Now, to be fair, this gentleman, he probably, that's a pretty fast pivot to try to get all of a sudden find somebody in the U.S. who can make his sneakers and everything. So, so it's kind of bad timing on it. But, I mean, again, it's not like you didn't know this was coming in a very real way. I mean, this was, Trump used tariffs in his first term. He told people for 4 years how he loved the tariffs and how when he got back in there, he was going to implement the tariffs. We had the big whole Liberation Day announcement in April. So, I mean, everybody knew that this new reality was coming. And I think that while it's tough, and you will see some cases like this, it's like, your job as a business owner is also to be adaptable. You have to adapt to the business environment. So I think he should have done a little bit better job, quite frankly, anticipating these tariffs and trying to pivot to try to find something else, because he knew that something like this was going to hit. Unless this guy just literally paid no attention to the news at all for a year, which I seriously doubt. To act like this, I just woke up one day and there was this $250,000 tariff sitting in my, it's like, come on, man, really? Like, come on. So again, and I think, my opinion here, I think CNBC cherry picked some businesses here that they wanted to pick on, like, oh, look at how horrible this is and blah, blah, blah. Well, again, it's not, you're pivoting back to a different business model. That's all you're doing. You're pivoting back to an American made business model. That's what you have to pivot back to. If you can't find somebody to make the sneakers in the US, maybe you should start making the sneakers in the US, make them yourself. Hey, SBA's got great 7A loans right now for manufacturers. You want to start manufacturing your own sneakers, the money's there. Banks are willing to lend. I think there's a lot of opportunity out there for people that start doing that, because the tariffs are actually, believe it or not, the tariffs are going to make it affordable for you to start making these products in the US again. That's what people always complained about. They always said, oh, well, it was always cheaper. It's cheaper to get it made over in China than it is in the US, because you have to pay US wages and stuff like that. Yeah, the only reason it was cheaper was because our president or presidents in the past didn't use tariffs to protect those industries. Now that you basically have tariffs protecting those industries, now you can shift back to making the stuff profitably again in America. Wow, shocking how this works, right? But again, something interesting I just wanted to share, so go through that. So, okay. All right, guys, it is that time. I'm going to get my story of the week here, get this wrapped up, and I'm going to get my quote of the week. But first, I just want to go into just a couple of things I'd like to go over at the end of every episode here. Let me get my banners ready. So if you're listening on Apple Podcasts or Spotify, I could really use reviews. So if you're listening on Apple Podcasts or Spotify, please leave me a review, as that would really help the channel, really help the podcast. So like I said, if you're listening, Apple Podcasts, Spotify, please leave me a review. Would love to have it. Would greatly help. Make sure to visit thebankernextdoor.com. Get a lot of good stuff on the website. Got news, articles, blog posts, and you can find every episode from the channel on there, live streams, all that stuff, everything on the website. So please go check that out when you have a second. If you have any comments, questions, or a topic recommendation, you can contact me at info@thebankernextdoor.com. Again, send me your questions, send me your comments, send me your topic recommendations. If you think there's something that I should cover, hey, send it in. Always happy to connect and take a look at stuff. You can follow me on social media. I am up on Getter, True Social, and X. You can follow me on any of those platforms. And just remember that BND is on YouTube, Rumble, and all major podcast platforms. We put out new episodes every week, Monday through Friday, premiering at noon. Episodes are usually about 10 to 20 minutes in length, so pretty short. Try to make them very digestible so people can just listen to them real quick and get on with the rest of your day. And then, of course, usually Saturday nights, BND Strategy Room live every Saturday night, 8 o'clock on Rumble or YouTube. I had to, again, this week, unfortunately, I had some family things, had to switch it off. But like I said, we'll be back starting next week. We'll be back on Saturday night at 8 p.m. our normal time. So, okay, let's go to our story of the week here. So, story of the week. I had done, tight monetary policy last couple of weeks. So now we're going to do what's called a soft and a hard landing. So a soft landing in economics is a cyclical downturn that avoids recession. It typically describes attempts by central banks to raise interest rates just enough to stop an economy from overheating and experiencing high inflation without causing a significant increase in unemployment or a hard landing. It may also refer to a sector of the economy that is expected to slow down without crashing. Now, conversely, a hard landing, in contrast, is often seen as a result of tightening economic policies that bring high flying economies that run into a sudden, sharp check on their growth, such as a monetary policy intervention meant to curb inflation. Economies that experience a hard landing often slip into a stagnant period or even recession. So there you go. So you have a hard and soft landing. So the next time Jeremy Powell is talking about that, you'll know exactly what he's saying. And then our quote of the week. So last week I did the quote on Milton Friedman, and this week I'm doing Benjamin Franklin. So any society that would give up a little liberty to gain a little security will deserve neither and lose both. And that is from Abraham Lincoln. Think about that one a little bit. Any society that would give up a little liberty to gain a little security will deserve neither and lose both. Okay, think about how that translates into today's world, in today's situation. So just think about that a little bit. Pretty deep. But anyway, all right. I thank everybody for joining me tonight. I hope everybody has a wonderful weekend out there. Thank you so much for listening. And I will see everybody again next week. Be back. Have a great weekend. See you guys later.